This is Michael Fox, and this is the Prospector News Podcast. And joining me today is longtime contributor and friend Chris Temple of the National Investor. Welcome, Chris.
Hey, Mike, how are you?
I am doing good. So 2 weeks ago, the Fed came out with another 3/4 of a point interest hike. And now Fed speaker after Fed speaker has been, coming out to the podium and talking the last 2 weeks. What can we fathom out of the comments that have been coming out of the different Fed members?
Well, look, what we can fathom is this, and I said this to you, I think, the last time we spoke, and that is that notwithstanding the initial chagrin over Powell being more hawkish in his press conference than some people expected, when you take the sum total of what the Fed's release said and then what he said in his press conference, what you come up with is that we have seen the last 75 basis point hike we're going to see. In December, they're going to raise interest rates by 50 basis points. You've got a softer consumer price index number a week ago. This morning, the PPI, this morning, of course, being whatever day today this is, Tuesday.
Tuesday the 15th, Chris.
Right. And so you got a little bit softer number there. So they're gonna dial down the pace of the rate hikes. All else being equal, they probably will end the hiking in this late winter or early spring, between 4.5% and 5% on the federal funds rate, which is, maybe a 50 basis point hike next month and 225s after that, and then call it good for a little while. But then they're going to sit there. And even Lael Brainerd, who's the vice chair, came out yesterday and pretty much said that. Some people took her comments as, quote, dovish because they're only looking at the headlines. But what the Fed is going to do is get up to where they want this terminal rate at for the time being and pause there. But they'll keep that rate through all of next year and perhaps longer. A lot of it's going to depend on how badly damaged the economy really is. If we start to see a meaningful rollover in economic activity, and I think that's coming. I mean, in just the last few days, you've had two major announcements out of both Federal Express and now Amazon, a lot of layoffs. And when is the last time you remember either of those outfits laying people off going into the Christmas shopping season?
That's virtually unheard of. They're generally trying to staff up.
Exactly. So the Fed right now, they have, I think, all but told us that we've seen the last 75 basis point hike. There's been some cheer in the markets from that. But look, the die is already cast, and we are going to go into this on again, off again recession. Doesn't mean we'll necessarily crash unless the Fed succeeds in breaking something in the markets that makes all of this worse. But we're in the great stagflation. I've been saying that for over a year, and it's going to be with us for quite a long time.
Yeah, I think you're probably correct. It'll be quite a while before we get back to anything that we would, even remotely consider to be normal. Now, when you talk about the upcoming interest rates, how do you think energy prices would factor into that? Because I still look over at China going, you're still in lockdown. What happens to energy prices when you reopen?
Well, look, longer term, we have shortages of just about everything going forward, including energy. This morning, a headline that some might be talking about in very different contexts is that the global population reached 8 billion for the first time. All of those people are trying to have better living standards, or their governments in the different ways are trying to give them better living standards. They all want energy. And so as far as the eye can see, it's going to be like it's been for our lifetimes now. Every year, energy demand goes up. You may change the mix as time goes on, where all those different things come from, but a growing global population needs more energy. And there's such a long stretch where we've had underdevelopment of resources. And as we've talked about more than once, between Canada and especially the US, doing a lot of things to harm our domestic industries, we're going to be kept with chronically high prices for as far as the eye can see, even if the economy weakens. Yes, demand might get hit a little bit, but the supplies aren't there like they were. We're still, here in the US, about 1.25 million barrels below what our peak production was before the pandemic. I don't see how we're going to get back to our peak production, especially with these new methane rules that are going to go into effect in 2023 here, that are going to put a bigger dent in production. So look, one of the many reasons why I believe we're into great stagflation, and why inflation it has no chance, zero, of coming down to the Fed's 2% target again, barring a depression. If they cause that, then we'll get low inflation for a stretch until they reinflate things. But one of the reasons is that we're going to have chronically high energy prices going forward, and even higher depending on what goes on in the world. And you mentioned China, Mike. If China's been trying to reopen in fits and starts recently, their COVID numbers have been spiking again. But even with that, there's a lot of reasons why their zero tolerance policy on COVID is going to be somewhat discarded. It has to be, because in that country right now, in the recent past, they've had trouble with people servicing debts. Forget about paying anything off. Their economy's a disaster. They've got the slowest growth forever. One of the many underreported stories of China's plight right now is that a lot of the manufacturing that was done in China has now left for Indonesia, Vietnam, and other places, Sri Lanka, a couple of African nations even. So, what China benefited from for so many years, having this big industrial base there, now they're losing it in the same way the US lost it a generation ago, when companies here turned China into a big mercantilist colony. Now it's being done to them. So they're in a world of hurt. And whatever the COVID numbers are, they're under tremendous pressure economically and policy wise to say, okay, we'll do our best to keep a lid on this as we can, but we can't bring life to a complete standstill because we got to pay our bills. So as they move in fits and starts back toward more normal economic activity, that's going to firm up energy anew. Because the biggest reason why you look at crude oil specifically has been a little bit weaker than other commodities with these recent rallies is largely because of China.
Yeah, I don't disagree. Yeah, I also remember America in the 80s when all those factories were closing and going offshore. That was not a pretty sight in America, and I can't say that China's going to enjoy that very much.
No, not at all.
So you and I, we often talk about Fed policy. And here in our little mining discussion, I've had several people say, why? What's the Fed got to do with mining ore out of the ground? And you and I off mic have had long conversations of how big an effect the Fed policy actually has on that. And I thought we should bring that forward on mic so people get an understanding of how important watching the Fed is and how it ripples into our sector of the economy.
Well, there's two ways to break that down, Mike. First of all, as is the case with all manner of economic activity and health, the mining sector and all extractive industries generally, as important as they are to development and to economic growth, they depend on an environment with monetary policy that fosters growth. Now, usually that has been looked at in terms of the Fed has interest rates low, they're expanding the money supply and things like this in order to keep growth positive. And you add to that the fact that commodities still globally are priced in US dollars. And if you keep the dollar, at an equilibrium, if not weaker than other major currencies, then the price of commodities is levitated a bit, which encourages investment, encourages development. So that's the one way in which the Fed traditionally has been a part of a key part of the discussion about the health of commodity markets or the lack thereof. All of the major times, in the last couple of decades or so, that you had commodity booms, investment wise, and for investors in stocks and things like that, was when you had good tailwinds from Fed policy. The most spectacular one being in the wake of the bear market and everything in 2000 through 2002. Then Fed Chairman Greenspan started to finally relent. He eased monetary policy, lowered interest rates. And when you added that was a big part of China's boom back then, those were glorious times to be invested in commodities in pretty much any way from 2002 to about 2007. You had a couple of fits and starts after the crash in 2008, where you had shorter times where you had pops in commodities and commodity stocks, but we've never really gotten back, especially where investors are concerned, to what we had from 2002 to 2007. So that's one way to address the Fed. The bigger one now, in my opinion, is that by its recent actions in first going nutso as an arsonist, with all of the money creation from early 2020 through, maybe the end of last year, early this year, however you want to measure it, the Fed had the dollar down, lots of liquidity out there, and now has lurched back in the other direction, where Jerome Powell supposedly, instead of being an arsonist, is now a firefighter. That has added a new disruption, worse than in past cycles, to commodities, and especially to the cause of investing in commodities, because these erratic moves, big in one direction then big in the other, if you're looking at investing in commodities, and I'm speaking again in general terms on all this, I realize that there are exceptions here and there with different commodities and different stories, but generally speaking, when this kind of a monetary policy today has you wondering whether in the next 5 years from now, is the price of a pound of copper going to be $5 or $6 US a pound, or $2 if the Fed overdoes it and crashes everything for a while? How much confidence and certainty do you have to put up any money, either as an investor, or more importantly, when we're getting in shorter and shorter supplies of a lot of things like copper, as an investment bank or as a mining major who has to determine where you're going to place your bets and a lot of your bank account on adding, ounces and pounds for the future. So this is the mess that the Fed has us in right now, as the elected officials are promising us, the sun and the stars when it comes to a green economy, an electric vehicle in every driveway, and all this other kind of stuff, but without remotely the supplies and supply chains and infrastructure to be able to produce all of these things. And again, you can blame this blame is twofold. It's on the policymakers, especially the Biden administration, for through a lot of different means hamstringing production. There's been some improvement there in the recent past, so I'll give them a little bit of credit belatedly, but also the Fed, as I said, where because of its monetary policy, we stand a very real chance of a 2008 style episode, either all at once or in slow motion. And that's going to continue to discourage investment, which ironically later means that the shortages will be worse and the prices will go even higher. So this is not the world that we should live in. These are not the choices we should face in a sane society, and with a monetary and banking system that benefits the people rather than protects itself.
Yeah, and that's just the supply and demand side of the equation. We've often talked about the actual development side of the equation, where you've got a mining company that's ready to build a mine, and now inflation's taken in, interest rates have come in, and is that mine that they were going to build even feasible anymore?
Yeah, and that's a good question. There's been a lot of examples in the recent past of companies, whether it's with existing mines where profits have been hit because of rising costs, whether it's with companies that, boy, 2 years ago we had a great looking project, and now our initial nut to get this thing built has jumped 50%. So it's hurt a lot of things. And this is really, Mike, and in the next Prospector News, the article that I'm going to be writing for you is going to go into this a bit deeper and talk about a lot of the pushback policy-wise today on the Fed, because the Fed institutionally, it can do nothing other than this. We should not have a private central bank. We should not have a fractional reserve system. And in the days to come, I'll be doing a couple of updated tutorials that'll be on my website and YouTube page to explain this in very easy, understandable layman's terms for the average person, so you know the genesis of all of our financial and economic problems today. But regrettably, the point that we're at is the Fed, to simplify it, gives us two choices in life when it comes to the economy and future growth and whatnot. Either we tolerate high inflation that they are, of course, the biggest cause of, or the price to pay to get that inflation back down is millions of Americans have to lose their jobs and we have to have a recession. I don't think we should have a Hobson's choice like that. And that, again, is why there's a lot of discussion right now on more legitimate types of monetary reform. And I don't talk in a sense of, we need to go back to a gold standard. If you had a gold standard under our present system, the consequences would be worse for the average person and business than they are today, because it would further hamstring the volume of money at a time that you have to change the system, not just tighten the money supply in the existing system. Students of history know that this was an epical point in American history on this subject under the guise of William Jennings Bryan and his famous Cross of Gold speech at the 1896 Democrat Convention. So there's a lot of pushback out there now, and it's not just coming from the gold bugs and people think we need to have a gold standard and whatnot, because the far more important factor than what substance is or is not behind the dollar is how does the system operate as a first matter in bringing new currency out. It needs to be public. It needs to be interest free. You need to get the banking cartel out of things. Some countries in the past in the developing world have done this via currency boards and things like that. But the time has come for a discussion like this, because between these policymakers on the one hand and the Fed in the other, we're heading for a train wreck with the Main Street economy.
Well, and the truth of the matter is the Fed and the policymakers seem to be on a collision course, because they're not on the same page. They seem to be going in polar opposite directions, but at each other.
Sometimes that's true, Mike, but in other ways it isn't. I was in a friendly argument with a colleague the other day, and who was suggesting that the Fed really doesn't deserve the blame for this. The Fed is doing the right thing now by raising interest rates, and it's Washington that's the responsible party, because whether it's Republicans or Democrats, they spend money we don't have. But who's the enabler? It's the Fed. For 40 years, since Paul Volcker changed our modern day system in 1982. And as I've said a million times, and this is on my website, this is the most important part of Volcker's legacy that nobody talks about. Since he did that, the Federal Reserve has monetized the national debt. Something that from Volcker to today, Fed chairmen deny. In fact, Powell is comical about it, because when he's been asked this a couple or three times by some of the older school monetarists, especially in the Senate, he says, well, no, we aren't technically monetizing the debt because quantitative easing is only temporary. That's absurd on its face, because we can see it's not temporary, at least the majority of it.
Well, in
So
Canada, the Income Tax Act was a temporary measure to pay for the First World War. So,
sure, everything is temporary, then it becomes permanent. So look, if the Fed was not enabling deficit spending and the bloated size of government and everything, it would never have happened, because the money wouldn't have been there and the market would never have tolerated it. You did at least see in the first part of Volcker's tenure at the Fed, before in later years the Fed decided under Bernanke to institute quantitative easing and all this other stuff. At least in Volcker's early tenure, you did see the market work on this, and the federal government was punished severely by deficit spending. Now, keep in mind that this was a $40 billion annual deficit under President Carter, who's got the worst bum rap of any president in history on this subject. And that level of deficit spending back then, and the Fed not covering for it, is what caused market interest rates to skyrocket. You know, the prime interest rate was up around 20% at one time. I remember selling money market mutual funds that for a short time were paying over 20% day-to-day return. Today, instead of a $40 billion deficit, we talk in terms of trillions, and interest rates are a fraction of what they were back then, even after these latest moves. Why? Because the Fed has enabled this. So
I won't even go that far back. I'll go to 2008, where everyone just about completely lost their shit because the bailout to the banks on the mortgage crisis was in the hundreds of billions, just with a B, dollars. And my God, that was too much in a lot of people's eyes. Now, you know, the Biden administration in the last 2 years has spent $5 trillion on different bailouts, and nobody even flinches.
well, no, they don't. And this, again, it has become so bold that it itself is becoming a part, Mike, of this discussion over the Fed as an institution, its viability and its worth as an institution, which is a long overdue discussion, as we all know. And you make a great point. You know, we're told now by the Fed that they've got to slow down, quote, the economy, which means Joe Sixpack and Sally Soccer Mom. But when it comes to enabling ugly debts, you know, for all manner of things, you know, whether it was that bailout in 2008, whether now it's, you know, starting a proxy war with Russia, and this obscene money that has been doled out to Ukraine, and this money laundering operation that's a part of it, which hopefully is going to come to light with this FTX scandal, and the relationship between that Bitcoin crypto operator that's in the press every day now, and Gary Gensler at the SEC, and the Biden administration, and Zelensky in Ukraine. I mean, they've got an unlimited ability to throw money around when it comes to stuff like this, but we're being told that when it comes to the average American, that we need to fight inflation by making sure you lose your job. Okay, this shouldn't be. We shouldn't have a system like that.
No, and truthfully, that should ever be a choice.
No, but it is. And that's why, for the first time in a long time, there is a growing consensus out there that the Fed needs to be re-examined as an institution, not just its interest rate policy, not just its open market operations, but why in the hell do we have a central bank that time and again has people who are spectacularly wrong, spectacularly destructive, and yet this is an institution that's still sacrosanct.
Yeah, and why did the Fed chairs keep getting reelected when, you know, they're so bad?
Yeah, that's right.
So if people want to hear more on your missus, where do they go?
Make sure you go to nationalinvestor.com. There's a spot on the page where you can sign up, if at the very least, for my free mailing list. That will give you a lot of my general commentaries, like I've alluded to today, the stuff that's very, very important that's coming on the Fed and this whole discussion of the Fed itself, a lot of the policy moves that will support the economy, not trash it, and things like that. So again, go to nationalinvestor.com. And actually, if you've not already done it and or not already seen this, if you sign up for my mailing list, you'll get a free copy of my latest special issue on the gold market entitled "This Is Not Your Father's Gold Market." Very hard hitting, I may say so myself. It annoys some of the promoters and conspiracy theorists among the Pied Pipers of the gold bug echo chamber out there, because I kind of call them out for a lot of the misinformation and nonsense that's out there, specifically in a precious metal space. But it'll give you a very sober, realistic, and non-religious look at precious metals investing, what to do, what not to do, and profiles on several of my own recommendations in this area.
Perfect. Until the next time, the next Prospector news should be out around Thanksgiving, and Chris's article on these topics will be available there. Thank you for joining me today.
Always great, Mike. Look forward to the next time.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.